Participants are waiting in the lobby. To admit all participants in the lobby, press star 2 1.
Please
Not
admit
my
our
job.
participants in the lobby.
Your fans.
The problem is there's not many bombs there and they just don't know who.
Okay, good morning, everyone. It's 9:31 according to the clock. Welcome all.
Oh, no, he's got it.
I'd like to call this meeting to order, the March 7th, 2024 meeting of the South Carolina Retirement System Investment Commission. Before we get into the agenda, Mr. CEO, is there any housekeeping or other notes or changes that we need to discuss or anything? No?
Yes, sir, I believe we're ready to.
Hang on.
I think we're ready to go.
Okay, first item up is adopting an agenda to use today, and I'll call for a motion to do so.
So moved.
I have a motion to adopt the agenda. Do I have a second?
Second.
I have a motion and a second. Do we want to discuss the agenda? Hearing nobody that wants to discuss the agenda, I'll call for a vote. All in favor, please say aye.
Aye.
Opposed, same. Ayes have it, we have an agenda. All right, next up is approval of the minutes from the December 7th, 2023 meeting. Those have been published for a while. I hope you've all had a chance to review those. If we have, I'll call for a motion to approve those minutes.
So moved.
I have a motion to approve those minutes. May I have a second, please?
Second.
I have a motion and a second. Everybody in favor of approving the minutes from the December 7th, 2023 minute, please say so by aye.
Aye.
Any opposed? The minutes are approved. All right, the chairman's report. I don't have anything to report this time. The committee reports, I'd like to hear from the chairs of the two respective committees we have.
Mr. Chair, those reports have been posted, so unless anyone has any questions, I think you can probably.
That's
Yeah.
fine.
Yes.
Any questions to the posted reports from the committees? Hearing none, I'm going to recognize Mike Hitchcock, our CEO, for his report. Take it away, sir.
Thank you, Mr. Chairman. This is the time of the year where we begin our annual consideration of our consolidated annual investment plan and statement of investment objectives and policies. So also, probably the most exciting time of the year that we have, especially I think it is from Mr. Condon and I, but I don't know if anybody else gets as excited about it as we do. But this year I'm going to go through some, and the way that our process works is I'll present a series of proposed changes to the document at this meeting. Certainly, any discussion that the commission would like to have on any of those proposed changes or any other proposed changes certainly would be, relevant to today's discussion. And then in the interim, again, once you've had more time to review, if there's any other potential changes that the commission would like to see, or any of the members of the commission would like to see, we can certainly consider those when we come back in April to adopt the AIP and SIOP. As I think everyone is aware, we have to adopt an AIP and review the SIOP both by May 1st. So that is the primary reason why we have a meeting in April, is to ensure that we are compliant with that statutory deadline. So without further ado, I'll go through the proposed changes. And also what you'll see is, primarily the proposed changes are technical in nature, or they're conforming in nature. We are about to embark on a strategic asset allocation review that really is, to a certain extent, kind of kicking off right now with some of the information that we'll get at today's meeting and presentations later on in the meeting. And we'll continue through with the thought of adopting a revised strategic asset allocation in April of 2025. I think, as everyone knows, we set ourselves a schedule back when we did the major asset allocation change in 2020 of taking a comprehensive view of asset allocation every 5 years. Time has flown by, and the time is now to conduct that review with the thought that we would approve it sometime in April of 2025. And the vast majority of the AIP SIOP is driven by that strategic asset allocation So the thought is, there's really not a lot that we would look to, request that the commission look at changing in the document this year, because we're gonna have, certainly a lot of time to look at and review and to make changes to the SIOP as a result of the strategic asset allocation process that we'll be going through over the next year. We do also have a few updates to some of the commission's governance policies. Again, trying to make some conforming changes to those. And those are referenced in the AIP SIOP, so we thought that this would be a good time to consider those, as for the commission to consider those as well. Again, primarily conforming changes, making sure that various policies are complementary to one another, because we do have a few kind of conflicts in the policies, but we want to make sure that we're being consistent across the board. And then, as I talked about, the major initiative for this year that we're including as a recommendation in the AIP is the strategic asset allocation review that we'll undergo really for the 24-25 fiscal year. So when we talk about the kind of the conforming and substantive amendments, and I have this broken out really into three categories: conforming and substantive amendments, technical amendments, and then governance policy changes. I don't really plan to spend a heck of a lot of time or much time at all on the technical amendments, but I can certainly answer any questions that anyone has in regards to anything that I'll present. As far as substantive amendments, we're recommending that we include some language at the beginning of the SIOP, just making it clear, designating the AIP SIOP as the commission's strategic plan. Like I said, the strategic asset allocation really drives all of what we do. And the AIP SIOP is that foundational document that really dictates what we do and how we do it. And it really is the commission's strategic plan. So we thought it would be wise to include some language indicating so. We update, every year we get new capital market expectations, and there are various references to funded status and how capital market expectations impact our expectations of reaching fully funded status, as well as contribution rates and when those could potentially start to come down. We see those in tables 1 and 2 every year, as well as the verbiage that's associated and explains those tables. So we've updated those. We've also updated our return expectations and volatility projections to correspond with what Verus has provided us based on their 2024 capital market expectations. As I said, we've added the strategic asset allocation review to the strategic initiatives, and we've removed deleted human capital, because we believe with all the work that the commission has done on the compensation policy last year in adopting, kind of finalizing our compensation policy changes, that we've finished that particular strategic initiative. We've also included some language, I think, as everyone is aware, what's commonly referred to as the ESG bill was signed into law. It does have a requirement that we provide certain reporting on proxies in our exercise of proxy votes. But there was some concern raised that, we needed to clarify that proxy voting reporting requirement doesn't apply to private equity, given the structure and the means by which we access private investments. So we included some language regarding that in the SIOP as well. Last year, if you'll recall, we adopted basically all of the language regarding the ESG bill that sets the particular requirements of that bill into the SIOP. So that's already in there. So we don't have to, there's nothing else that we need to do to implement that, other than, we thought that we needed to tweak the language when it came to the proxy voting section.
So the language that we thought they were going to use, they used.
That's right. Yes, sir. That's correct. Yes. And we already had adopted it in the AIP SIOP last year.
Okay.
We've included a update to our managing sourcing disclosure to reflect our practice. And this is really directed at staff, and our current practices at IIC meetings The members of the IIC and other folks who have worked on the investment certify that they have no conflict with the particular investment. And given that we do that at the meeting, we've just changed that change the requirement to reflect the practice. We've also clarified the electronic reporting requirement for our public market mandates. And what we've done there is we've tried to tweak the language so that it reflects the capabilities of our third-party process and the monitoring service that we have to accurately reflect their capabilities. And then in the delegation policy, the investment authority delegation policy, we're recommending a change to the investment pipeline reporting that we provide you, going from monthly to quarterly. There's not a substantial amount of change to the investment pipeline on a monthly basis. It does require, a decent amount of effort on staff's part to provide a report that really doesn't show a tremendous amount of change from month to month. We give you that pipeline at every quarterly meeting, so we're just recommending that we just change that from monthly to quarterly. And that's kind of a forward look at what investments that we have, that we may potentially do that are in our pipeline. And then do you have a question, Mr. Conn? Sorry.
Yeah, you go back to manager sourcing.
Yes, sir.
I've been meaning to ask you this question for a couple of months. An investment advisor, Merrill Lynch, recently asked me, well, how do we know, what you're looking for, what you need that we might be able to provide? Mm-hmm. How do we go about? Do we kind of know what 3 or 4 managers we want to talk to, or is that a combination of them coming to us, or how do we let people know what we want?
And I can try to answer that, and Jeff, if you want to jump in too. It's a little bit of, the answer to that question is yes, because it's a little bit of, it's managers that solicit, us. It's a lot of times it's managers that, when we're looking to invest, a lot of times it's just managers that we've already invested with, and some, we now have a stable of managers in pretty much every asset class. And, we also use Alborn, for instance, as a sourcing mechanism for potential new relationships. We use GCM, our co-investment partner, as a potential sourcing mechanism for new relationships. So there's a kind of a panoply of potential mechanisms by which managers are sourced. And what we're doing is, Jeff and I, because of our unique involvement with every investment, as far as this goes, we certify for every investment that we don't have a conflict, with and we're not involved with sourcing the managers anyway, because it's very much of a bottom-up, process. But because I close every investment and Jeff approves every investment, basically, we certify that we don't have a conflict for every investment. And then whoever.
Is it Bank of America that owns Merrill Lynch?
Yes.
So I would assume their people know what we're doing if they wanted to get involved. I mean, the investment advisor at Merrill might not, but
Yeah,
people at the bank
the local
probably.
guy probably doesn't know.
Yeah.
And we do have a relationship through the Russell overlay with Bank of America.
Yeah.
So we're sort of dealing with, I was a local financial advisor
Yeah.
at one point in my life, so I feel like I can say this. We're dealing with the top of the house now,
Right.
which is not the local guy helping people understand how much they need to save and what a
Right.
individually
That's what I
tailored
figured,
investment
but-
program needs to look like.
Okay, thank you. Thank you all.
Yeah, no problem. And the last change is, there was a existing conflict between, when it comes to terminating an investment manager, between, we have the section, kind of the general section on investment policies, and then we have a separate, policy regarding the investment authority delegation. And in the investment policy section, it allows either the commission or Jeff as CIO, and with my oversight for Jeff, to terminate any manager. But when we passed when the commission approved the investment authority delegation policy, we limited that to the amounts of the delegation. So we're just conforming that delegation policy to the existing authority that really actually already existed, and that's just something that we just didn't catch when back then. So it's just conforming those two policies so that there's no inherent conflict. At this point, given that we've had the delegation policy for a pretty significant amount of time now, there's really it's kind of a distinction without a difference really as to, Jeff's authority to terminate a manager, because most of the managers that we would potentially look to terminate, we've done through delegation anyway. But there is also a requirement, we can retain the requirement that if we terminate an investment manager, that Jeff provides you with a memo within 3 business days, just like we do with closing an investment. So. I'm really not going to spend hardly any time on the technical amendments, certainly willing to answer any questions, but these are really just either adding additional verbiage for clarity's sake, or just changing a few references and like one technical correction. But if anyone has any questions about those, certainly willing to. Yes, ma'am.
I don't know where it is, but one thing just sort of caught my eye, having been edited over 40 years of gender inclusive language, and I think that phrase is a little awkward, where you say including the other gender. It's simpler to just to say using gender inclusive language, unless there's some reason why we can't.
I'll make that.
Yeah, we'll take a look at that.
Okay. It's just an editorial thing, but I think it's,
Okay. Yeah. Yeah.
especially there are people who don't identify with either gender, so.
Okay.
But that's not the main reason. It's just simpler and clearer, I think.
Okay. Yeah, we'll definitely take a look at that, see if there's, And then, governance policy-wise, you'll see there's some recommended changes to some of the commission's governance policies. In the commission's roles and responsibilities, we added a code reference. We also, in the list of roles and responsibilities, we included a reference to the fact that the commission has adopted and has delegated investment authority. So we brought that up to date. In the CEO and CIO roles and responsibilities, we conformed the reporting of compensation and employee changes to the compensation policy that the commission has separately adopted. So we made those two agree on to whom and what information we report to the commission and to the HRCC, to basically to conform to the comp policy that the commission has adopted. We deleted a conflicting provision related to the CIO review, because that's also included in the compensation policy. We updated some decision-making authority references to reflect some changes that were made in the 2017 legislation, and to reflect that investment authority has been delegated to the CIO. We added a code reference for clarity's sake. We also provided for there's a mechanism by which there can be emergency succession in the case of the incapacity of my position, allowing the chair to appoint an emergency interim successor until the chair can call a commission meeting. And we've also added a notification requirement if something were to happen to Jeff as the CIO, like he wins the lottery, not get hit by a bus, because I'm told we're not allowed to say that anymore. But he wins the lottery, then and quits, then I can appoint an interim successor, but I just have to notify the commission, and that language wasn't in there previously. Under commission operations, just provided a reference to that we do education presentations at meetings. We've added some of the items that we do during commissioner orientation to the list of things that are in the expected at orientations for new commissioners. We've updated a reference to that we stream the commission meetings as well as have them in person and conference calls. So we've updated that. We've conformed the evaluation of my position to our current practice, and what's reflected in the compensation policy as well. And we deleted a requirement that the commission publish a summary of the commission evaluation That's not something that we had been doing as a practice. And it also seems a little bit incongruent with, what you would ordinarily expect when you're doing some type of a review like that. For instance, like a review of an employee, you would necessarily expect for that to be published in any other, in any other source. So those are the proposed changes. Like I said, certainly willing to answer any questions, and if there's any discussion, turn it back over to you, Mr. Chair, to see if there's any discussion or any questions. But otherwise, we will look to come back in April and adopt any and all of these proposed changes that the commission sees fit to adopt.
So what I just heard, fellow commissioners, is that we just got a homework assignment and it's due at the April meeting. Okay? All right. Thank you, Mike.
Yes, sir.
Next on the agenda is the Chief Investment Officer's report. I recognize Jeffrey Berg.
Thank you, Mr. Chairman. All right. Thank you, sir. I always have to look at this to make sure I don't hit the wrong button.
So, well, I did.
Okay. First of all, our custom is when we're looking at June or December performance to try to not just limit ourselves to looking at the fiscal year to date, but to spend a little time looking at some longer term performance, and we'll do that throughout here. But before I get to that, I just point out that was quite a quarter in the fourth quarter. Our plan returned 673. I admit I'm a little bit surprised that we outperformed the benchmark, given that we were underweight public equity, which gave us the biggest uplift during the quarter. Our total plan value has eclipsed the previous high, and we are now north of $42 billion, almost 42 and a half. Net benefit outflows, I do love pointing this out because this has exceeded my expectations, and I think collective expectations. During the calendar year ending December 31st, we can see that our net benefit payments, looking at the bottom of the page, under $100 million. And that is just phenomenal. It really makes it affords us a much stronger liquidity position from which to manage the plan. It just, in essence, makes doing this easier. So I always like to pat the General Assembly on the back.
You want to pay off the obligation? Is that what you're saying?
I'm sorry?
You want to pay off the obligation? Is that what you want to do?
We don't have that much money yet, but we're getting there.
Hopefully shortens the time horizon where the state has to be kicking in 16%.
As Mike and I like to say, it's a math problem. More money in makes everything work. So,
Jeff, I'm sorry, is that
sir.
inclusive of all cash flows, or is that just contributions less benefit payments?
Correct.
Okay.
Contribution. This is the amount that we have to add to the contributions. So the net amount that's coming out of the plan, which we turn back clock 6-7 years, this was 1.2 billion, I want to say. We had one bigger year as we unwound the Terry program. But this is so manageable. We can fund this and have plenty left over out of our bond portfolio, out of our equity dividends. I mean, this is a very, very manageable amount now. So, let me draw your attention to the 3 and 5 year returns, the excess returns specifically. We have been very fortunate to catch quite a strong wave of excess return over the last few years. And I asked David King, who's in the room, and he'd love to review this with anyone, I'm sure. How much in dollars is that excess return over 3 and 5 years? And the amounts are eclipsed what I thought he was going to come back to me with. Over 3 years, outperforming by 2.82% annually. That has resulted in $3.5 billion more money in the plan than if we had just performed in line with our benchmark. And on a 5 year basis is approaching $4 billion. So we've been very, very fortunate. And, it's easy for me to sit here and say this, but this is a function of the great people that we have who are putting their shoulder to the wheel all the time to try to help turn this thing around, and the results are looking good right now.
Jeff, could you
Yes,
just
sir.
briefly review the policy benchmark, how that's defined, and does it change, or?
That's the target portfolio the commission adopts, so that's 5 asset classes, 46% public equity, 26% investment grade bonds, 9% private equity, 7% private debt, and 12% real assets. So think of that as real estate.
Okay, and how often, do you change that during any period?
We haven't changed it since June of 2020. But this meeting is when we begin the process of reviewing it with an eye to changing it this time next year.
5 years?
What would cause you to change it?
Changing expectations for asset class returns. Frankly, it's a great question, Ed. If we looked at that 1 year, how much net benefit payments do we have to fund? That number 5 years ago was north of $1 billion. So we are now in a much stronger liquidity position, which means we have a different kind of decision to make when it comes to asset allocation. So we may choose not to, but we could afford more illiquidity risk, given the fact that we are not, responsible for 4% of the plan in annual benefit payment outflows. So, does that help?
Yeah.
Okay.
Jeff,
Yes, sir.
question. So we didn't have our current policy benchmark 10 years ago,
Correct.
but is the 10 years and since inception still based on our current policy benchmark or the
No, it
then
is
applicable?
the then current. It is the actual policy benchmark each year during those 10 years.
Okay.
And we're just linking those together to make a 10-year return. So it's not the current portfolio policy return.
So it's just 3 years backwards that is on the current policy.
It's about 3.5 years now.
Yeah, 3.5 years
But I mean, of those numbers up.
of the current target portfolio. And then once you get earlier than that, then frankly, it was a portfolio that was changing every year a little bit.
Yeah.
So,
But yeah, Holly, like, as you said, that policy benchmark return for 3 years is the current.
Right.
All of that is the current policy benchmark, that's right.
so any further questions before I?
Well, but it's really driven, I mean, obviously everybody's working very hard here and you can see it in the numbers. But I think part of it's probably driven by the markets. I mean,
Yeah, absolutely, absolutely.
We're killing it right now, but that all could change.
Yeah, I'll put it slightly differently. We've had a nice tailwind for the last several years.
Yes. I guess I
Tailwinds
have.
can very quickly turn into headwinds.
Yes,
And,
no.
but
I look at my statement every day, actually.
yeah.
Well, Ken, one of the things we kind of, like, one of the beliefs we kind of ground ourselves in, and it's reflective in the SIAP is that, that policy allocation that the commission sets, that we're using as a benchmark to judge against, is supposed to be reflective of the majority of the return that we earn, right?
Yep.
So, and sometimes we classify it as that should represent about 90% of the return. So, that's why the commission's decision to set that policy allocation is such an important one, because that is the
Conservative.
ultimate driver
Yep.
of the return. So we expect that to, as we've kind of said over the course of several, I guess, almost, at least several meetings and, over the course of a year or so at least, the outperformance that we see over the 3-year period is cartoonish to a certain extent. Yeah, I mean, that's not what we would expect.
Yep.
A good outcome would be if that was 70 or 80 basis points above. That's a great outcome,
Okay.
right?
So I'm doing backflips.
Yeah.
We outperform by 1%.
Yeah, that's right. So,
Mike, the outperformance over a 10-year period shouldn't have had a more positive effect on the unfunded liability?
well, what you see over that 10-year period though, Ed, is that the total plan, the total plan return is actually going to be what makes the difference when it comes to the impact on the unfunded, because for part of that time period, the assumed rate of return was 7.5, and then it dropped to 7.25, and then it's 7. So for this kind of discrete 10-year period, because of, because of markets, primarily because of the way markets have performed over that time period, you see that, we've underperformed, the total plan has underperformed that assumed rate of return, any of those, basically especially the blended assumed rate over that time period. Now, like at the end of the fiscal year, though, the 10-year return was above the assumed rate of, over the current assumed rate of return of 7. So, we do see a little bit of, kind of up and down in that above and below the 7% assumed rate of return or the right now.
I know Jeff always likes to be cautious about comparing to peers, but we need to just put that 3-year number in context on a risk-adjusted basis, that your return is in the top quartile while your risk is well below median relative to your peers. So you had higher returns with lower risk over that 3-year time period. So your risk-adjusted return ranks in the top third of the overall universe. So it's been a good 3-year run.
I agree. I still don't like that as a metric, but it's very kind.
Yeah.
Yes, sir.
So what that's telling me, and tell me if I'm wrong, every one of those time periods, the total plan is greater than the policy benchmark, which means our investment staff is making good decisions to not violate, but to differ from the policy, and selecting good managers. That's what that's telling me.
Yep.
But when the and I don't really mean but here, but in the 3 years, that's such a big difference. That's got to be is that primarily our overweight to private equity and the great returns we had during that period in private equity?
There's certainly a little bit of that.
Before you answer that, let me follow up with another question on that. In a later slide here, don't you differentiate manager selection, execution? So I think, Bill, the answer to your question is probably upcoming and where he dices out where that difference comes from.
I'm gonna do that, but what we have here is only over a shorter period of time.
All right.
So, but yes, that is part. A not insignificant part is not only being overweight, but being overweight when private equity had its best returns relative to public equity.
Right.
Which frankly, this last year reversed.
Yeah.
But there's a lot of that. We have had fantastic execution across, which I'll show you in a second, across several asset classes. So it's really been a very fortunate period for us to have made some decisions to look different, had those decisions work out, but then the everyday blocking and tackling of our staff, in terms of how well are we executing in private equity, has just made a tremendous improvement over the last kind of 6 years. So
Yeah, I think that shows kudos are due to staff.
absolutely.
Yeah.
And you're not looking at staff on that one.
Yeah.
That's the staff that you're not looking at. So let's move to
That's the slide I was referring to.
our framework. So the first thing that I want to point out is at the top left corner, the 1-year return for the reference portfolio. As a reminder, this is the 70% public equity, 30% investment grade, U.S. investment grade bonds portfolio. That is what we would think of as the simple portfolio that has a level of risk that we expect over long periods of time to best correlate to the target portfolio or the policy portfolio. So we look at those two next to each other, and down in the yellow, we see that over the last year, simple has radically outperformed the diversified approach. But over 3 years, it's currently showing the benefit of diversification. Candidly, if the stock market continues to rock and roll, this will pretty soon, the 3-year number would turn negative. If it does not continue to rock and roll, I have a lot of confidence in the policy portfolio to outperform that. So looking in the middle of the page, the quality of portfolio structure, which is how does the portfolio we have structured in a top-down sense performed against the policy portfolio? So this is going to pick up decisions that I make regarding what are we overweight and underweight, as well as how are we actually trying to design the asset classes. So over the quarter, we had some underperformance, but you can see that there's been some nice, modest but positive excess return over the last fiscal year, 1 year, 3 years. But Bill, to your question, over the last 3 years, where we've chosen to look different has worked and worked it worked out a lot better than we expect it to normally, because I don't think we really looked all that different. But the things that we did to look different, seemingly most of those paid off. And then the last yellow box is the kind of the design of the portfolio, the blueprint of the portfolio is the implementation benchmark. Let's compare how our managers actually performed against that. And we've had fantastic outcomes there as well. So does that help answer, in a sense, Bill, what you were kind of getting at?
Yeah, no, that gives more detail to it for sure,
Okay, great.
and verifies what I thought from the prior slide.
So let me kind of head on address the 40 basis points of underperformance. We are overweight private equity, and in order to be honorable risk-wise, I don't think that it makes sense for us to ignore that overweight. Yeah. So we typically offset that with an underweight to public equity. Now, we are not offsetting it dollar for dollar because equities were down, so we had more equity than you would just use as an offset, being underweight in that asset class. So that is what's driving it, though. Public equity had an amazing quarter, and we were underweight. So that's the big story in that particular box. This is fun, and I don't often get to say this, but each asset class in our portfolio, whether you're looking at 3 or 5 years, is outperforming its benchmark right now. And I say that, I feel like I need to knock on wood because that will not go on forever, but it's fun when it's happening, and that's another reason why the 3 and 5 year returns are, as Mike used the term, cartoonish relative to the benchmark. So we've been very fortunate and had a lot of very good things happen. Now, if I move to a shorter time period, you start to see a little bit more what I think is kind of normal, where I'll refer you to the bonds portfolio, where over the last year we have underperformed. That is a function of the fact that when we hold cash, it is treated as bonds in our asset allocation. And we are very liquid. We are holding more cash than we typically do in order to remain flexible during what I think is still a bit of an uncertain economic and frankly geopolitical time right now. Private debt, I do like to give Alan Bavard, who's running private debt for us, a hard time because he's underperforming by an alarming amount here. But frankly, this is really just a function of the fact that his benchmark is a public listed benchmark. And it's strange when you look at the fiscal year that actually a debt benchmark outperforming equity doesn't seem like the kind of thing that we expect. So he is simply the victim of a benchmark that's just having an amazing year right now. But when you look over 3 and 5 years, you can rest assured he's doing a great job. So the other thing I would point to on the 1 year basis is portable alpha hedge funds. This is how much have the hedge funds in our portfolio outperformed the cash rate. We expect it to be better than 77 basis points over time. So it's been a bit of a tougher year for them, still adding value, but just not the amount of value that we expect over longer periods of time.
Jeff, what is the cash rate currently?
I would say 5.25%.
Thank you.
So, but that's not what it was throughout those 12 months, but that's what it is today.
I understand.
What's happening with private equity? I mean, we had some great returns, I guess, right, in the prior years and.
So if I think about
Probably a stupid question, but I'll try it anyway.
the appropriate way to say this. Thing I'm most proud of is you look here, 5 years now, it's outperforming. If we look at this 5 years ago, it would be underperforming by a much greater amount. So this has been the story of a turnaround for that portfolio. And, we really we kind of shut down doing private equity for a little while we got our feet under us and figured out how do we want to do this. And then when we relaunched our portfolio, we were just doing it better, frankly. I could give you a long answer to that,
No.
but I don't think that would be entertaining for anyone other than me. So.
We believe you.
So.
The other comment or observation I had was in real assets. I mean, you got negative 68.68%.
Yep.
1.53, but it's way outperforming the
Yeah, it's kind of
benchmark.
strange to have a negative number be associated with where we're having the most success, isn't it? Real estate is having a tough moment right now, and that's the real assets benchmark. We have a bit more of a diversified approach because we have not only real estate, but we have infrastructure. And infrastructure has been holding up very well for us relative to the kind of tough moment that real estate's having right now. We talked a little bit about that at the last meeting, but I don't think that real estate is out of the woods yet. But we are starting to get our ducks in a row for how do we, if there's a real moment to be opportunistic, how are we going to do that?
Yep.
So that's how we're spending our time, but there is a meaningful outperformance there, and that's really how you should think about where that's coming from.
Or you sandbag the benchmark.
I'm sorry? Bad benchmark? Yeah.
Really good results, great results.
Thank you. All right, so real quick, let's move into some attribution. I'm going to try to go faster through this, but here we're looking at the fiscal year to date. So the overweights and underweights, as a reminder, what you want to be is, let me make sure I hit the right button here. You want to be underweight something that's performing badly or overweight something that's performing well. And I already alluded to, we are underweight global equity, which has performed very well, and overweight private equity. And down here, the allocation effect, you can see, is explained by those two things. I probably am overusing this little spotlight thing, but I apologize.
That's okay.
So
Shiny new toy.
implementation, this is largely a good news story. We have, where we have looked different than our benchmark so far this year has been productive, most notably, as we just alluded to, infrastructure, floating rate, investment grade, and listed real estate. And then manager selection, again, the private debt portfolio being up against a benchmark that I don't think is reasonable to expect that it would beat this year, is the only thing that is flashing negative here. And this is just a sum of all of those that delivers us from 4.08, which is the policy return, to 4.75. This is a different way of looking at it. I've grown to like this way of looking at it because we can kind of just, the total column over here is a nice little summary. So we are underweight bonds, but overweight duration. So we're able to see that in essence, those two things are washing each other out. So it's a different look at it. The 75 basis points coming from real assets, though, is definitely the star of the show. So let me.
No, if you go back to that slide,
Yes, sir.
this is probably dumb questions again, but when I was looking at the allocation of -14 and -16, -5, can you explain that?
Sure. So let's see here. So let's zero in on the -14 and -16. Okay. And let me go back. Hopefully I'm not exiting anything here. So, all right. Our target to private equity is 9%. We have 13%. And for the fiscal year, ignore the 1.77%. Those numbers really only relate to whether or not the benchmark for private equity, because the other effects are going to tell us how we did. But is the benchmark for private equity essentially better or worse than the benchmark of the total plan? So it's worse. We're overweight the thing that's worse. Think of it that way.
Mm-hmm.
So that has to have a negative impact. And then similarly, we're underweight. Our target to public equity is 46%. We're underweight public equity, and it had a 7.36% return, which outperformed the benchmark for the total plan. That was 4.08. So those both are bad. So let's jump ahead. And that is why over here we have -16, -14. So, and then like that's how the comparison works in that column.
Gotcha.
For each asset class. So let's jump. I can't tell you how disappointed I was that we had this huge rally, and I thought that our private equity portfolio was going to get back inside of the 5 to 13% range. We are almost there. But actually, we had some good things happen in the private equity portfolio that prevented it from happening. So it's not a terrible problem to have, but I was hoping that I would finally be able to have the yes in the far right column, but we're not quite there yet. So risk slide. I asked our risk folks to do one enhancement to this, and I'll let you all decide if it's an enhancement or not. We have a big number and a little number in each one of these boxes. Very simply, the little number is what was it last time. So you can get a little bit of a sense, meeting to meeting, how these numbers are evolving. And by and large, there aren't a lot of really meaningful changes outside of this number over here. There we go. Our what we call tracking error from how we are positioning the portfolio relative to the target portfolio has declined because we've been taking action to get the private equity weight down. We've had the equity market rally, so those things are moving in the right direction. And as a result, what we call the tracking error, which is a measure of the risk of the difference between the returns from the target portfolio and our implementation portfolio,
Who measures that,
is
the risk?
falling.
Do you guys measure it?
Yeah.
Okay.
Yeah. James Wingo's team. So we are slowly looking more like the
If I look
target
at the
portfolio.
actual 13.4% risk, what does that mean?
That is the volatility of the portfolio measured on using monthly data over the last 3 years. So it's not I don't want it to be confused with what our friends at Verus are going to show us, because we're just measuring the last 36 months
Okay.
of the returns for each one of these things that we're
Because
measuring.
I look at 13.4% risk in the accounting world. When we look at risk, I get a little nervous, concerned.
Yeah. Well, yeah, this is, we like risk if we can use it to make money. So,
Okay.
but, so you'll feel better about this then. The bottom row is actually what have we observed in the actual outcomes for our portfolio. So, 8.4 is a lot lower than 13.4.
Yep.
So that is, the bottom row is the numbers that marry with the actual performance of the plan. The top row is what do we believe the risk to be? So we don't always see risk show up in return, but I think I've said this a number of times. Woe be unto the man who does not understand how much risk he has. So 13.4 is how we think about the risk in our plan. 8.4 is what we're able to see. So let me pause there and see if there are any questions. Yeah, all right.
Any more questions for Mr. Byrd before we move on to the next item on the agenda? All right, next up, we're having an actuarial update from the folks from GRS. You all have the floor.
Joe and Danny on.
Thank you, Mr. Chair.
All right.
Pleasure to be here. We're fully caffeinated and ready to go. So with me, my name is Danny White, actuary for GRS. With me is Joe Newton. If we go to the next slide, we'll kind of get through an agenda of what we'll talk about, some historical demographics. We got the next slide. There we go. Perfect. I'll go through the valuation results for SGS and PORs as of July 1, 2023. It may sound dated, but that's the latest and best that we have at this time. And the next valuation will be at July 1, 2024. And just as important, or most important, is Joe Newton will go over the projection information. So I'll kind of give you a snapshot of where we are today, and Joe's going to let us know where we're headed. If we go to the next slide, contributing membership. It gives you an idea of the historical membership, how it's changed over time. If we look through go from top to bottom on the bar charts, we have working retirees on top. You can see how they've decreased over time. There were legislative changes made back in 2012 that made it less enticing to be a working retiree. And you have the state ORP, that's the state defined contribution plan that state employees and educators, public school employees can elect to participate in. And we can see that has increased over time. And that's not surprising. Some of that's gone with the change in 2012 in terms of the Class 2 and Class 3, which I'll get into. The red bars, the Class 2 members, these are active members who participated in the system or joined the system prior to July 1, 2012. Class 3 are post July 1, 2012 members. The benefits are similar, except that the vesting for Class 3 is 8 years. It's got a longer vesting period, and there's also you have to work a bit longer to be eligible to retirement eligible. Those two things kind of make the state ORP the DC plan a little more attractive, especially with the immediate vesting on the ORP. If we go to the next slide, contributing members in SCRS, how in terms of the counts, how's the retiree counts changed over time? You've got beneficiaries on top, disabled retirees in the green, and red regular retirees in the red. You can see that steadily increased over time. We expect this trend to continue at least for the next 10 years before maybe leveling out. Go to the next slide, contributions, benefits. This is your net cash flow from the plan. So we have benefit payments in blue, the top bars. The lower bars in green are the contributions. This is member and employer contributions into the system. If we think of it in terms of net cash flow, benefits out, less contributions in, divided by assets. 2012, your net cash flow was a negative 1.4%. That gap was closed to about negative 0.7% for 2023. We can expect that gap to close one more year in 2024 because the contribution rate has increased again from FY 2023 to FY 2024, the employer rate. After that, the employer rate is going to remain steady. So you're still going to be the increases in contributions as payroll increases, but that gap or that the level of steepness or that level of change from year to year is going to be more steady. And by the way, if anybody has any questions, feel free to interrupt as we go along. Okay, if we go to the next slide, actually the next two slides, we'll go through the valuation results here. On the investment side, it's actually a pretty quiet year in terms of compared to the assumption. Actual return came in very close to the 7% assumed return. Keep in mind that our valuation for determining contributions also has a 5-year smoothing. Let's take that difference between the actual return and the expected return that gets recognized over a 5-year period. It takes out some of the inherent volatility or short-term volatility. But as of right now, the calculated value of the actuarial value and the market value are approximately the same. So it's pretty mundane in terms of the investments. The most notable side is on the liability and the membership experience. We saw an increase in active membership for both SCRS and PORS, and noticeable pay increases, 7.3% annual pay increase for SCRS, and most notably a 14.4 for PORS. This is what we saw for PORS. It extended across all the groups, so it wasn't just state employees, but it was also local government. And the KCSCRS, we can say the same. It was state employees, local government, and I think a bit larger for public school.
Hey, Danny?
So it's, yes, sir.
This is Jeff. First of all, thank you guys for spending time with us. The 7.3% pay, do I understand that as 2.5% growth in the census and then almost 5% growth in each, like sort of on a per person basis?
No.
No?
So we had I put it this way: you had the annualized pay is covered payroll, our membership payroll, total membership payroll increased 7.3%. So some of that inherently is driven by increase in members.
So basically, it's the cumulative impact of we have more people and we're paying them more than we necessarily expected, right?
Absolutely, that's exactly right.
Okay.
And this on the liability side, we'll show you what this does on the liability side. Actually, we can go to it on the next page.
Hold up, Danny. Bill Hancock, Chairman. Could you go back a slide there? There we go. When we went up from 22 to 23, 7.3% and 14.4% respectively, part of that, I'm assuming, had to do with some of the maybe the state, but some of the locals paying their employees, what I call the premium pay for COVID money. They were using some of their ARPA funds to pay out bonuses and give pay increases to. Have you folks factored in a reversal of that one time, or I guess for 2 years in a row they may have done? Have you folks factored in a reversal of that?
Well, I wouldn't say a reversal of it. I would say it's more of, we factor it as being a one-time, it's more of an anomaly. It's not a sustainable increase. So in effect, we're, there's still going to continue to be pay increases. And I think in terms of the, what drove what, I think the pay increase drove the increase in active members, and not the other way around. I think, once you increase pay for a position, that position all of a sudden becomes more attractive and easier to fill. But in terms of the COVID money, this is something we've seen across the country. As other states are same situation as South Carolina. So we're not putting in a reversion where it's going to go back down, but I think it's going to stay at this level, but increase at a more normal pace. Joe, you have any other comments?
No, and as we get to the projections, you'll see that this increase hits both sides of the balance sheet. It does increase the liabilities on our on paper as of June 30, 23, but it also increases our projected revenues due to these increases, and they basically balance each other out over the next 15 years or so. And so even if it's true, and so to answer your question directly, no, we did not build any sort of reversion in or a decrease. But it's because it really hits both sides the same way, and it wouldn't have impacted the ultimate conversation of our vow. So it felt like complexity that was necessary. But it also, I don't think it's a given yet that there will be decline. I don't think it's a given yet that the employers won't figure out a way to fill in that gap because they're still having a hard time finding people.
Okay.
How much of that?
All right.
I have a question. How much of that pay increase do you think was the specific legislation around public school teachers? They must be a fairly significant component of the total membership.
I think they're about 40% of the active members.
And the General Assembly actually had two significant pay increases. They increased public schools as well as they increased public safety. So the big vacancies in Department of Corrections, they increased starting salaries for corrections in order to fill a number of those positions. So there were some long-term sustainable pay increases for those positions.
This is not falling primarily on local governments. Yeah.
Correct.
I think does the 5% state COLA, that gets picked up, will get picked up in this year's valuation.
Like
Yes. Okay, right, yeah, because that's prospective rather than, no, I got you.
Okay. We do have more information about the pay impact on what it does to the plan, not only in the immediate term, but on the long term. So on the actuarial accrued liability, here we are in the snapshot summary. You think of the first rows being the balance sheet. You have the actuarial accrued liability going from almost 57 billion to 59 billion for 2023. I'll note, and we'll show that later, about it was more than 637 million of that being more than expected due to pay increases, but we'll show how that balances out going forward. And then on the asset side, assets increased. The unfunded liability, it also increased by about 200 million. Absence of those abnormal pay increases, we would have saw a decrease in the unfunded. But that time's coming soon, we believe. Member contribution rate stays at 9%. The employer contribution rate went to 18.56 for FY 2024. That's what employers are paying now, and that's the cap of the. It was a phase in as part of Act 2017, and that was the ultimate level reached. So we are there at that plateau. There's also a second trigger to make sure that you're not that employer contribution rate is adequate, and that's based on calculated funding period. And so as long as that funding period is 25 years, and it's going to tick down each subsequent year to 20 years. So as long as the calculated funding period remains below that maximum funding period established in statute, that 18.56 will continue to be sufficient. And we'll show that we do project that 18.56 to be sufficient going forward. You can look at the expected contributions for members and employers. You can see where it's in both cases where there's an increase in the expected contributions. That's an expected increase in covered payroll. So even though the member and employer rates stay the same, we're still expecting more dollars to come in just on the fact of payroll. For PORs, it's a similar story, just kind of different magnitude in dollars. All right. We go to the next slide. Let's talk about impact again on the salary increases. We'll go to the last 2 years. There was more the actual salary increases. Think of the COVID money and the other legislative flexibility. You know, the budgets were in surplus. Need of active members or employees. So they increased salaries. You know, they had more than expected or assumed based on the valuation. You can see the impact for PORs. There's both a liability increase the last 2 years. As Joe noted, the liability increase occurs immediately because you got the immediate salary increase, larger salaries, larger retirement benefits being paid or projected to be paid, bigger liability. But we're also getting more contributions coming in each year because of those revenues. Since the systems collect contributions as a percentage of payroll, if there's more payroll, more dollar contributions. The expected contributions that came in versus what actually occurred. In last year, we got 95 million more just because the pay was more. And that's just that's a single year. And if you project that out going forward without a reversion or anything, the present value of those extra contributions, as you'll show, they impact or they kind of wash out against the immediate increase in the liability. So as Joe will show later on, that the impact on the projected funding period or when you attain fully funded hasn't materially changed.
Danny, can I ask one question?
Absolutely.
The contributions on the left are expressed as more than expected. Is the liability increase the unexpected liability increase or the total unexpected? Okay.
That part is the increase in liability more than expected just due to salary increases.
Okay. I just want to make sure that I'm understanding those relative
Absolutely.
to each other.
Yep.
Thank you.
We're trying to compare. We're isolating just impact of salary experience.
Yep.
Yeah, but one thing is that the liability increase is a total liability increase. The more than expected contributions is a 1 year number that you're seeing.
Yep.
Can you go back to slide 8 for a second? I have a question. Our total contribution rate on the SCRS, 27.56%. How does that compare with other states or other public employee plans that you have, that you see? Is that
It's pretty close to the
It
average.
seems high to me, but what's that?
It's pretty close to the average right now.
Okay.
Yeah, I was going to say it it is averaged a little bit higher, but also keep in mind the average funded ratio for plans is 75%. You're below average on the funded ratio, and as that
Rate's gonna go up.
plans, below average on funded ratio should have a higher contribution rate.
Yep, okay.
And Danny, while the overall contribution rate might compare, I think our member contribution rate is a good bit higher than that average across the country. I mean, isn't the average for public employees who are Social Security, as we are in South Carolina, is somewhere around, 7% maybe. It's not 9%. Is that correct?
That's an accurate statement too.
Well, and to piggyback on that too, I mean, and our members pay probably a significant greater percentage of the normal cost of their benefits as well too, right? Because the normal cost of benefits is what's like 10, 11%, yeah, so.
Yeah, so what Mr. Hitchcock is referring to on the normal cost, the value of the benefit being earned is about 11% of pay on average. And so the members are paying the majority of the benefit, and the majority of the employer contribution is going to finance the unfunded liability.
Right.
Yep. Thank you.
Great question there. So, are there any questions on the salary experience before it turns over to Joe?
One other thing that I would point out, Danny, because there were some questions about using ARPA money for bonuses, et cetera. Bonuses don't go into compensation for benefits. So if there were bonuses paid out with ARPA money or special funds, that wouldn't increase ultimately the benefits because bonuses are not included in compensation for benefit calculations.
Do they pay contributions on this? Do you pay contributions on the bonuses?
Not if they're bonuses.
I couldn't remember the difference there.
All right.
Okay. So let's go forward. We're going to talk about, now we're going to kind of, how is the projected or looking forward information change? This is the kind of a big picture of what that funding period looks like. The red is the liability, and the part on the left where it has a solid line is the actual trend of the liability the last decade. Then dashes become the projected, what we think the trajectory of that liability is going to be based on the current assumptions and the current benefit provisions in place. And then on the bottom are the asset values, and you have the market value in green, and then you have a 5-year smooth version of the green of the market value, which is the actuarial value coming with it. And you can see generally the last decade it was flat for a while, and now it's beginning to pick up. You begin to see increases in that total value of assets. However, the last decade you can see the liabilities have outpaced the growth in the assets. We now expect that to change and for the assets to begin to accumulate much faster liabilities. And a lot of that's because of the contribution rates now hitting the top of the schedule. And what it's really done is shifted, and Danny brought up the cash flow earlier. It's basically pushed the cash flow so that the system is going to retain a lot more of the investment earnings that are generated. So if you think about it, if you had $100 of liability, you should be generating $7 of investment earnings every year. Well, if you have big negative cash flow, maybe you're paying out $4 of that, $5 of that, and only getting to keep 1 or 2, and that's why your assets relatively flat for a while. Well, now going forward, you're expected to keep, as much as $6 of that investment earnings, and that's where you're going to get the accumulation. So if you think about it from an individual retirement planning perspective, the system as a whole is shifting back closer to accumulation phase for the next 15 years than distribution phase. And so that's why you get that, quite accelerated asset growth for these next 15 years. The next slide shows the history of the unfunded liability.
And can I ask a question? I'm sorry, I didn't mean to interrupt. Can I ask if you go back a slide, can I ask a question about that? one of the things that has been very beneficial is the decrease in the net negative cash flows, especially as a percentage of AUM, right? That we've seen as a result of the pension reform legislation. But if, we kind of did some back of the napkin math, and if we were fully funded right now and only receiving the kind of the normal cost contributions, that would be a significantly higher number, right? From a net negative cash flow situation. So when we're thinking about, kind of managing the overall liquidity, and if you think about the duration of the entire portfolio, right? When should we, is there kind of a thought or when we should start taking that into consideration, that those net negative cash flows would start to increase as a result of contribution rates going down to reflect the increase in funded status? Yeah, and what the glide path should be, because that's something that, obviously we're starting to, success breeds sort of kind of another problem to a certain extent, right? So we just want to be mindful of how that impacts, kind of overall decision-making on our part. And I know Peggy, I know that's something that you brought up and have been mindful of too as well, that, that's something that we should be considering as we move forward and get closer to that fully funded status. Because, at the point of the contribution rates being so high is, you get to fully funded faster, right? But then once you get to fully funded and kind of thereafter, you kind of have that net, because of the mature nature of the plan, you do run back into that sort of net negative cash flow situation.
Yes, you absolutely do. And I think the timeline part of it, you guys have to answer, right? Because y'all are the ones making, especially your private decision, your private investment decisions of how long does this run out? When does this liquidity change? But I think on the other end, I think there's two, ideas or ways to strategize around this as we get closer to that 100% funded. So I think a lot of people would say, well, we get 100% funded, the contribution rates can drop from 1856 down to, say the 2% normal cost or something. I think that this cash flow argument is a reason to not do that, or at least not do it immediately, to have some sort of phase in. But also, I think it also should come into play of what your investment return assumption should be at that point, because that's one way to manage that net cash flow is, there's no reason it has to go all the way down to 2%. Maybe if we were using a 6.5% return assumption at that time, it would drop down to 4%, and that gives you guys a net cash flow that you're comfortable with. So I think that's one thing. If you look back, say the late 90s, and the way people were managing these plans, and they had the really high investment return assumptions, 8.5%. I think that knowing what we know now, I don't think it's fair to go back and tell those people they should have done something different. But knowing what we know now, a different way to think about that would have been, well, what negative cash flow support over time, and back into what investment return assumptions should that mean we should use.
Sure.
And so I think those are just discussions to have. And since we're only 16 years away, or at least sooner than we think, to actually have them.
Right.
But yes, I don't think getting to 2040 and having a gigantic spike in your net cash flow is a good thing. I think it needs to be managed as we get closer.
Yeah, I think that's definitely a opportunity to have us all working together, to ensure that we're taking that into consideration as we get closer to that, and how that impacts the various parts and pieces of the plan, and especially how we manage it. Because if we drop the corresponding impact is if you decrease the expected rate of return, then that has a impact on the liabilities, right? So that kind of potentially extends out when you get to that point too, so it's an interesting kind of push-pull situation that we may find ourselves in. So having those conversations often and early, I think, is a good way for us to proceed.
I absolutely agree with both of you. The other part is that as the plan gets better funded, the legislators, the employers are going to want to know what's going to happen in the future for their budgeting process.
That's right.
And for that reason, some pullback, I think of it in terms of a contribution rate management policy will come into play to outline and be transparent about what the plan is, not just for you guys for investment purposes, but also for the employers for budgeting purposes.
That's right. Thank you.
All right, the next slide is the unfunded liability history and kind of a one-year projection. And so you could argue, well, does this slide actually belong in the projections group or whatever? I think it does because we need to see the unfunded liability begin to come down. It gets to where, well, how can you continue to say you have a funding period? The definition of that is how long till you pay off the unfunded if you've never actually seen it come down. Let's get started. So we were really a little disappointed with this year's VAL results because of those salary increases. It kept the unfunded liability from declining. It was expected to, and just the salary increases alone held it flat. We do expect 2024 for it to begin to decline, which is going to be a pretty big, turning point in the history of this program, and to be able to start seeing actual, what I consider tangible evidence, like not projections, not hope, but actually see it on paper improving, is going to be a big point in the history of this program. So we do expect that this next year. Now you can see it's not a huge decline. It's kind of like a mortgage. It starts small and begins to waterfall on itself. And so it's definitely small enough of an expected decline that salaries could bother it again, potentially. Luckily, investments, we still have 3 months to go, but generally those probably are not going to be a reason we don't decline. Assumptions aren't going to change enough to decline it by any means or change it all by that point. So it's really going to come down to what happens with the salaries. And is it enough to offset this? Next slide. This is the projection of that unfunded liability compared to last year's, and this is to show that how it does deviate up front. So the light bars are what last year's projected unfunded liability was. You can see we expected it to begin to come down. The dark blue is this year's projection. So we're starting out a little higher, but because we're also expecting that higher revenue stream, it pays it off at the same point in time in 2039. Next slide. This was the stress test. And to me, if you look back at especially the 2017 change in the schedule of contribution rates, and you say, well, what best practices could the rest of the country pull from what happened there? And to me, a big part of it was using a stress test, setting up the contribution schedule to really give a really high probability of success to the whole situation. And so back in 2017, instead of just assuming the 7.25 investment return assumption that was in place at the time, the schedule we'll call scenario 5B, which to now, we're now 6 or 7 years, is like, why are we still calling it schedule 5B? Well, that's what it was called then. And it was basically, okay, well, what happens if we only earn 4% this next 5 years? And then we actually have an investment return assumption adjustment down to 7, which were both, the 7 part was kind of highly likely and ended up happening. But the 4% for the 5 years was a stress scenario. And the contribution schedule was actually set on that basis. And so what it did was build in some margin. And you can see here, the blue bars are the actual contribution schedule going forward, the contribution as a percentage of payroll, the blue line. The green, I guess, is where our current expectations are for the valuation. So if the valuation assumptions are met. But the red dotted line is again back to stress scenario 5B, which is, well, what if the next 5 years are only 4% returns? And you can see that even if the next 5 years are only 4% returns, we really are not expected to get anywhere close to the 1856 requirement in the statute for change. So right now we have a very high probability of the 1856 being an appropriate amount, going forward. The next slide, bring in some visualizations of what would it take to trigger. And so we'll talk about the bad outcomes first. Well, a 0% return every year going forward, we would hit a trigger in 2032. That's a pretty big drawdown.
We'd also hit another
if returns are 2% per year, every year, we actually would hit the 1856 in 2042, which is right at the end of the current expected funding period. That's like that's the line. Like if someone said, well, what does it take for us to have to hit the 1856? I would say as long as the plan exceeds a 2% return going forward, it's very unlikely you're going to have to go above the 1856.
Joe, can I ask
On the other end of the
Can I ask a question about that? I'm
Sure.
sorry. Is that annual or annualized?
like an annualized return. So
Okay.
two.
Okay.
So yeah, I mean, it could volatility itself into certain situations, but
Because I was wondering if that's like if it's a, if it's a -2 + 4, -2 + 4, like that kind of, that gets.
that would be fine. I think the thing that could hurt us is like -30, -20 or something, some big drawdown that takes a while to recover might get it quicker. But if it's just low returns, it's going to be pretty close to this line, I guess.
And this is a simplified approach. The only thing we're modeling is the return. You can imagine if the investment return is 0 over the next 8 years, there's other bad things happening in the economy that could affect things on the budget and employer side. So this is just a very simplistic kind of illustration.
Yeah. And then on the bottom are positive things. What would it take to get to fully funded sooner? So an 8% return realized gets you there in 2036, so about 3 years sooner. If we get 10% returns, you get there about 2033. So again, about 3 years sooner than that. So it just kind of shows you the range because we the assumption of 7% is a middle ground expectation. Reality could definitely be different than that, especially over a shorter term. The next slide, we've been introducing some probability outcomes because, again, like the last slide showed straight lines. We know it's not going to be a perfect straight line. So what are probabilities doing as we move through time? Well, you can see there at the top, from 2021 to 2023, probability of getting to 80% funded by 2030. Now, there's nothing magical about 80%, and there's nothing magical about 2030. Okay, they're just round numbers that we picked so that we had something to compare to. But you can see that is actually declining. The salary increases and just the difference when you have a point in time that you're comparing against like that. A little bit of deviation behind, it makes it harder to get there. But the third one down, you see probability unfunded is smaller than it is now. Back in the 2021 valuation, that was coming off that huge return year. And then 2022 was more of a pullback. So you now see about 70% chance that the unfunded liability is smaller than it is now 5 years from now. But to me, the big one is the bottom one, which is what's the probability that we ever exceed the 1856 requirement. And you can see that that's come down, and now in 2023, that about 8% of outcomes would exceed it at some point, and that it could exceed it by 1 basis point, right? Like it's not saying that it means we have to jump to 20 or anything, but as long as it never exceeds it at all, that's a 92% probability that it never exceeds 1856. All right, that's at the end. I think we're getting close. Next slide. Oh, some projection for forward. It's a very similar story. You can see the salary increases up front were even bigger compared to expected. But likewise, that means the revenue stream is also bigger. Now, it doesn't quite equal out to the same year at the end. You can see now there's a little bit of unfunded liability left in 2038 versus last year we thought would be 0 by 2038. But not a big difference in that timeline. Next slide. So just to finalize here, the funded ratios are beginning to increase. So the funded ratios have increased the last few years. The unfunded liability has not yet, but we do expect that to begin very soon. It should be either 2024, potentially next year, depending on salaries. And then it's highly likely that the current contribution levels for the employers will be appropriate going forward and not have to revisit those at any point in the future. So our recommendation is to, stay that course. There's a good plan in place and it's working, very close to expected, and, just continue moving forward and the contribution rates staying where they are. So that's everything.
Any questions, comments?
All right, Joe, Danny, thank you for your time and your presentation this morning.
Likewise, it was a pleasure. Thank you.
Thank you, guys.
Thank you. Take care. All right, actuarial updates in the books. Next up on the agenda is our friends from Verus have a 2024 capital markets expectations presentation, and Mark Brubaker,
I need to
Ian
stand up
Toner,
for a
and
minute.
Mike Patowski.
Take my seat.
It's been suggested to me, and now that it has, I concur. Let's do a 5-minute comfort break.
That's fair.
um, 2024 capital markets expectations, and hope to hear lots of good information from them. I'll yield the floor to Mr. Brubaker.
All right, thank you, Mr. Chair. And maybe before I get started, I think most of you had a chance to meet Ian Toner before the meeting, or you met him in the past. But Ian Toner is our Chief Investment Officer. He joined us from Seattle, came down for this meeting and to get some shrimp and grits while he's here. So he's going to be doing the more interesting part of this presentation. But this is an exercise we go through every year where we look at Verus's capital market assumptions. And again, these capital market assumptions that we put together, they're 10-year forward-looking assumptions, and they're market assumptions. They aren't. We don't incorporate any active return, any manager excess return into the mix. And so this is something we do every year. And maybe just to kind of hit the highlights first, we ran your portfolio using our new capital market assumptions. And again, this is something we do. We publish at the end of every calendar year. And your portfolio return did decline slightly. Your expected return declined to 7.3% from 7.4% using our prior year's assumptions. But at the same time, the risk also decreased from 12.7 to 12.5%. And we'll go through that in a little more detail as we go through. But both of those numbers, as you can see, are comfortably ahead of your 7.0 actuarial assumed rate of return. And just to put some perspective on that 7.0, I think that's pretty commonplace. The average state retirement system, the expected return is now, it just dipped below 7%, so it's 6.9% for the average state retirement system. But again, our methodology is intended to be forward-looking, so we're, we have different ways of coming about coming up with our expected returns for each asset class. Ian's going to go through this in more detail, but just to give you an example, you can see for U.S. equities, for example, at the top, we look at the current dividend yield. We add to that the real earnings growth, the historical average, the inflation forecast for the inflation on earnings, and then we do have a component of the expected PE change. So if an asset class is trading richly, i.e. at a high price to earnings multiple, there'll probably be a negative adjustment for an expected PE change down in the future. And if it's trading cheap to historical averages, it'll probably be an increase to the expected PE. You can see private equity. We use the large cap domestic equity forecast, but we have a beta adjustment of 1.85 that we apply to that to reflect the higher risk and higher return expectation of that asset class. Bonds, as Ian's going to show you, bonds are relatively easy to forecast, simply taking a look at the current yield to maturity of the portfolio, and that's been a highly accurate predictor over longer time periods for that. I'm not gonna go through this line by line, but suffice to say, we have a, kind of a disciplined approach to looking at this. We're not trying to make, these aren't Ian Toner forecasts or Verus forecasts. We're trying to interpret what the market is telling us about future expectations for returns in these major asset classes.
And that's the key point. You'll notice if you look on this page, none of the inputs are our opinion about one of these lines. These are all observed data from the best sources we can get, because we want to make sure that we're using market pricing, market views, rather than sitting in an office and using our own dartboard. This gives you the basis for as robust a capital market forecast as possible, which you can then have views on how the world might differ from what the market is pricing. We don't want to sort of feed those views in before that sort of that dispassionate approach is created.
Would it be inappropriate to ask what the Verus dartboard says? I won't hold you to that, Ian.
Well, we look at markets, and we've got opinions about markets all the time. And so that is what we do.
We might talk about that later.
We can absolutely do that.
There's a lot of dart marks on the wall around the board. But these are our assumptions. You probably had a chance to take a look at these. Global public equities, we have an expectation long-term, again, 10-year return of 6.9%. This will be relevant to our later conversation, but ex-China is virtually the same at 6.9%. U.S. stocks, we have large cap stocks, S&P 500, our expectation is 5.9%. There's two reasons when you look at that relative to international developed, where we have a return expectation of 8.1%. So pretty significant premium for international stocks over U.S. stocks based on these expectations. Really two primary drivers of that, and Ian's going to talk about that later, but one is the lower dividend yield to start with in U.S. versus non-U.S. And then the PE adjustment that I talked about earlier. U.S. stocks are trading rich relative to history, while international stocks are actually trading cheaply relative to history. So that adjustment makes the difference there. You can see emerging markets. We have an expectation of 8.8%. Maybe I'll use the flashlight tool here just to highlight some. Private equity, 9%. As you'll see, that's actually an asset class that has declined from last year in terms of our return expectation due to the leverage embedded there. I'll talk more about that in just a minute. You can see down below cash, expected return of 4.1% for cash. So, it wasn't long ago that you would expect 0% in cash. And then we have, just focusing on what might be relevant to you. Oops, there we go, wrong button. Looking at, we use Core Plus fixed income as your fixed income proxy. And there, whoops, I shouldn't use the flashlight. The Core Plus expectation is 5.2%. That's been a significant increase over the past several years, and we'll talk a little bit about that as well. Going to the next slide here. Again, private credit, which is a meaningful part of your portfolio. You can see our 10-year expected return there at 9.2%, actually slightly higher than our expectation for private equity. And then other, which are predominantly real assets and hedge funds. And you can see that for hedge funds, our expected return is 4.3% there at the top. Real estate, for your real estate expectation, we actually use a combination. It's a blend of core real estate and value add real estate. And you can see our expectations there for core at 6.8%, value add real estate at 8.8%.
What do you consider value added real estate?
Value add real estate is real estate that's primarily leased up, but there are opportunities for improvements and further leasing opportunities in the building.
Commercial real estate.
And that sits between core. Core would be kind of Class A, primarily fully leased property where you're generating income. And then opportunistic real estate would be, primarily development opportunities and major reconstructions.
What's the basis for the 2.5% inflation, and why doesn't it have a standard deviation?
So the inflation number is forecast based. from other forecasters. So you have 25% weight to the University of Michigan survey, and then 50% is the market expectation from the pricing of the 10-year TIP, the 10-year TIPS portfolio. So all we're doing is saying, what is the market expecting and what are forecasters expecting?
Okay.
It would appear that one of the biggest negatives in any of these projections is this $36 trillion US debt, which is scheduled to increase. So is that all factored in here?
No, so in as much as the markets are factoring it in, yes, but we don't have a special and additional component. And the reason for that is a couple of things. First of all, what we're trying to do is we're trying to create a non-opinion-based forecast given all of the data that's available to us. Secondly, the question about the sustainability or otherwise of the federal government's debt structure is one that there's lots of opinions about. It's certainly not certain. Most people will agree that it feels uncomfortably high, but there's a very wide range of views about when the markets will address that, and indeed whether. So is that something that will cause a problem this year? Is it something that will be kicked down the path of 10, 20, 30 years? That's not clear. And so that's the kind of thing we try and keep out of these forecasts, because that's a ripe area for discussion and boards may choose to discuss that issue. Our view in general is that it's a matter for concern because government finances are important, but it's not a matter that's predictable enough to price into portfolio expectations today.
I guess one of the considerations is that has been talked about here recently is the fact that because of the size of the debt and the cost for long-term debt, that much more of it will be financed in the short end, which will keep pressure on short rates.
Absolutely. So there are implications from the market standpoint about the demand for different types of treasury paper and the supply of treasury paper. There's also for example, in the piece, I come out with a piece every year at the start of the year, looking at 10 things to think about for the year. And one of the questions is the fragility. So we don't invest based on politics and when elections are happening, but we recognize, for example, that where you have large amounts of government borrowing and what you might call a complicated election year, that creates a greater probability than normal that someone might slip and fumble the football, and that might cause some market concern. It's a more fragile environment than if government borrowing was lower. So that's how we kind of think about this in the context of markets, rather than saying there will be a government debt crisis in the next 10 years. Simply to say we recognize it increases the degree of fragility at times where other things are more fragile. And the possibility the bond vigilantes will be back is higher now than it has been for certainly most of my career. Early career, I remember that happening. The last 20 years or so, people haven't cared about it as much as I think people are beginning to start having it on the agenda again. Does that make sense?
Great. And you had asked the question earlier about what drives changes to the asset allocation policy, or why would we do an asset liability study. There's a lot of different factors that would drive a change. One of them, I think that Jeff mentioned, is change in our capital market expectations. And so you can see here, this just shows at a high level certain asset classes and how they compare to last year. And some meaningful changes. You can see, as I mentioned earlier, private equity, our return expectation for private equity is down 1.2% from where it was the year prior. Private equity relies heavily on leverage and levered returns, and because the cost of leverage is higher, that's dampened our return expectation for private equity primarily. The other thing I'd point to, if you look at core plus fixed income right there in the middle of the page, the return expectation is 0.6% higher than it was the year before. But if you went back in time and looked in 2020 when you last did the asset liability study, which predates Verus working with you, but I would venture to say that the expectation for core plus fixed income at that time was below 2%. It's now 5.2%. So significant difference in our expectation for fixed income returns, let alone the other asset classes. So that's one of the main reasons why you look at this every 5 years. Some of the other things I think, and Jeff touched on, change in liquidity needs, change in the liabilities. You just heard in the actuarial presentation that there was unexpectedly high salary increases that impacted the liabilities. So things are constantly changing, and so we agree with Mike and Jeff that we think every 5 years is an appropriate time to really take a hard look at the asset liability characteristics. So here on this page, we have a couple of different portfolios that we look at. So on the far left-hand side, we have looking at your asset allocation, your actual allocation as of 12/31/2023. So as Jeff walked you through, private equity, even though your policy allocation is 9%, it ended the year at 13%. Private debt was overweight at 9% as well. And you can see the expectations for that portfolio with a forecast return of 7.5%, with a standard deviation or risk of 13.1% based on the assumptions that I just reviewed. We then look at your policy portfolio there in the second column, and you can see that asset allocation has a slightly lower return than the actual because of the lower private equity and private credit allocations, but still a 7.3% expected return with a standard deviation of 12.5%. And that includes portable alpha. So the way we model portable alpha, you have a 10% target allocation to portable alpha, and so we treat that as a hedge fund return expectation less the cost of financing. And that's how that impacts the overall return.
Look,
So
Mark, just to be clear, we have no target return to portable alpha.
no target allocation.
Yeah, that's off benchmark.
Right.
So
that.
But because I think what you're saying is because we've had it, it's kind of always on right now. You model it that way.
We model it that way, yeah. It resides in your fixed income portfolio, frankly. They're porting that alpha onto fixed income. So that's just another way of looking at it. I think that if you look at the policy without portable alpha, which I think is what goes into your SIOP, that is 7.3% with a risk of 11.8 or a standard deviation of 11.8. And then finally, on the right-hand side, we have the reference portfolio that we've talked about earlier too, 70% global equity, 30% bonds. And there, that return expectation is 6.5% with a risk of 12.3%. So if you just contrast the mix second to the right to the reference portfolio on the right, you're really gaining about 80 basis points or 0.8% of additional return through the diversification that you put in place. And you've actually lowered the risk through that increased diversification overall. Any questions on that before I turn it over to Ian? Ian's going to talk a little bit more about our methodology. And keeping in mind that one of the things Mike said at the outset, this really is kind of a kickoff to what we're going to be doing throughout the course of the year, which is a series of educational presentations on asset allocation, liabilities, how asset liability studies work, culminating in next year with the presentation of a new asset allocation policy. So I will turn it over to.
Thank you.
Ian, do you want to?
I will try and break the machine as
Do
well.
better than I do.
So the next few slides are partially talking about the process that we have and partially also talking about some of the shorter term and opinion ideas that add on top of this, that what we see happening in markets at the moment that are good context for making decisions about portfolio structure. This is, because I'm a massive nerd, my favorite slide in our capital market assumptions book. And basically what this chart is, and this is really important when we're thinking about asset allocation work, to have this slide in your mind, because most of the time when we talk about forecasts, and for example, when we go back to these pages, you can see here, let me see if I can, oh, well done, I managed to make it. So you see these numbers here, they have delightful precision, don't they? They're to one decimal place and they're exact. you might possibly be able to surmise that the idea that you can forecast any capital market to one decimal place over the next 10 years is a rather brave assumption about the predictability of the future. But we have to use a number for the purposes we're talking about here. You do have to have a number to say our expectation for global equity is 6.9%. So it's not that they're meaningless, because they're not. But the reality to hold in your mind as we think about an asset allocation policy is that those numbers are the little white dot in the middle of each of these distributions of possible outcomes. They are effectively the middle of the distribution of outcomes that we think might happen. Okay? So they are correct as a description of the expected return of each of these asset classes. But it's important to remember that when we say, for example, emerging markets, it's just below 10%, right? 50% of the time, it'll fall into those ranges. That makes sense. Because we recognize the future is uncertain. So I kind of have a trope that I say the right order of magnitude of all forward-looking investment calculations is not measured in decimal places, it's ish, right? Because the future is uncertain. And it's important to hold that in your brain as we think about this. Yes, please.
Going back to your assumption on equity returns, the
Yes.
previous slide,
That one.
U.S. large.
Yeah.
5.9. Wouldn't that appear to be on the low side? I think the average since 1928 is in the 7 to 8%. So
Yes. So it is low, and there's a couple of reasons for that. It is low relative to history. So there's three key elements that go into that forecast. One is inflation, which is higher, but still that's a part of the story. In fact, we'll come to the individual, see which slide. So here we are. So this is the forecast we have here. So you have the orange below the line is expected valuation change, is the fact that U.S. equity is expensive relative to history, and therefore that's a negative component of the return. And then the other elements of the return are the historical real earnings, so how much does the U.S. equity market historically earn, is the inflation forecast, and then the current dividend yield. And that, you add those up to get your expected return. And so the reality is, yes, it is low relative to history because it's not paying terribly high dividends relative to history. It's kind of expensive relative to history, and inflation is, on a 10-year basis, not massively out of control relative to history, although it's higher than we'd all like it to be at the moment. And that gives you a number of about 5.9. So that's also what we say about the fact that we don't put opinion into this. We're just saying, what does the data that we observe tell us about the likely behavior of these markets over the next 10 years? So,
and then I think maybe also to answer that question, so if you look at wherever U.S. large cap is in there, and you might be saying, well, wait, that 5.9 is right in the middle of that distribution.
Yep.
That's a forward-looking distribution based on the not only the expectation, but then the volatility around that expectation.
Exactly.
So it's not looking at history, it's looking forward.
And so U.S. large, when you look at this range, it's this one here, right? So the important thing to hold in your mind is the expectation on average is there, that's the 5.9. But there's a big range of possible outcomes that are reasonable given that background that you might occur without saying the forecast was wrong, if that makes sense. Because the forecast is to say the average expectation is here and there's potential deviation around that just because of the randomness of markets. So,
Ian, I think this is, this is probably one of my favorite slides in your presentation as well, because I think, and this is probably a look under the hood that we haven't necessarily, had as focused as much attention on, is that, when we think about the overall return of the portfolio, the expected return, the building blocks, there's volatility in the expectations of the building blocks in that, which builds to, a probabilistic outcome of the overall return as a total portfolio, right? I mean, that's, so the underlying expectations themselves from a portfolio perspective have, a range of outcomes because the underlying building blocks have a range of outcomes, right? So,
And one of the things that we sometimes hear when we talk about capital market assumptions to groups like you is we sometimes hear, well, that's changed a lot since last year. And the reality is asset class 10-year returns are much more volatile than people think they are. 10-year returns can actually move quite a lot from one 10-year period to another. So there is uncertainty based in, it's hard enough to describe the past, let alone forecast the future, right? There is uncertainty built into everything we're doing. And we try to make sure that the expectation is clear, so you've got an understanding of what's likely to happen, but also a feel for the ways things might go wrong and the differences you might see just because of the randomness of the building block components and the way the markets fit together.
And just for clarity's sake, the randomness and the underlying expectations, the range of probabilistic outcomes, that's not something that's unique to Verus's, the way that you guys do capital market expectations, right? That's embedded in every capital market, set of capital market expectations that you get is that those asset classes themselves are going to have a variance and probabilistic outcome.
That variance is always there. One of the things we try and do, though, is we try and make sure that every board we work with has seen this slide to understand that variability is there. It's easier to go, the number's 5.9, right? But it's more important for you as decision makers to understand the number's 5.9 and there's a range of possible outcomes around it, because that helps you put the decision you're making in context. So that's why the nerdy slide, for which I apologize. And that the conversation we just had about the variability of long-term returns, you will notice in the expectations that we have, if you go back, you will notice that our US large cap at 5.9 and our high yield corporate credit at 6.6. There's a difference there, right? At the moment, on a 10-year expectational basis, high yield's expected return is a little bit higher than public equities. And so you see that number and, oh my goodness me, I can't believe that's ever possible. Well, here you go. These are the variable returns that you have had over time. These are 10-year rolling returns of US large cap equity and high yield corporate credit. And the answer is, yeah, most of the time, US large cap equity outperforms high yield corporate credit. And about 30% of the time, it doesn't. So what that will mean is about 30% of the time when you're looking at capital market assumptions, you'll look and you'll go, holy cow, high yield is expected to outperform US large cap, and that's completely normal. It's not common, it's not universal, but it's also normal in the range of things that we see in markets. 10-year and 30-year forecasts, we use the same fundamental approach. We tweak the data sources a little bit to try and make sure the data sources are good, but I won't get you into the detailed nerd ball of that, because that really is, what's the best data source for dividend yield over multiple time periods and so on. But it is the same methodology that we use. You can see broadly these things track. There are some differences, but there are 30-year numbers available for you if you want. Again, if predicting 10 years out into the future is hard, predicting 30 years is mind-bogglingly hard. There is one thing to look at, though, which is to be aware that if you begin to compare, there's one challenge, and we purposefully we flag this, but we flag this to make you aware of it. A 30-year forecast includes an implicit 10-year forecast, if that makes sense. So if your 10-year forecast is 5% and your 34-year forecast is 10%, holy cow, that's a hot year 11 to year 30, right? So we don't explicitly tie them together, but because the methodology is similar, there's a rhymingness to it. If you look at some of the forecasts that are out there, you can see some fairly brave 10 to 30 years, because often people use historical numbers for their 30-year. And if the historical number for an asset class was very hot, and the forecast for the next 10 years of that asset class is very not, then there's a kind of joining up point you have to think about. So I just wanted to flag that. Again, this is the building block process we use. Simple building blocks, each of these drivers. And if you can think about the underlying idea here, it's about how much income are you getting from the asset? How cheap is the asset? Is it reflective of inflation? Does inflation drive the asset? Those are the basic ideas underlying all of these capital market assumptions. So international developed, as we said, and emerging markets are higher than US because they're undervalued relative to the US, and they pay you more dividends, and so on and so forth. Fixed income is higher this year than it has been previously because of the fact that fixed income is paying you more. Yields are up because prices are down. And again, each asset class has its own contributor. So for example, high yield, you can see the effect of default is material. High yield bonds do default. Same with bank loans, they do default, but you get paid to take that risk. You would expect to get paid to take that risk. This is a very pretty picture of all of the co-relationships between the asset classes. Simply making the point, and this will be used behind the scenes for helping build that asset allocation, simply making the point that each asset class has a relationship with each other asset class. Those relationships are relatively stable compared to return, but you need to be able to take them in mind. This is the thing that gives you diversification, which allows you to drive smoother outcomes than would be the case if you put it all in one asset class. So a little bit about the opinion component we were talking about. So this is a shorter term description of what's going on, but to give you context of the environment we're in now and how that's affected to some extent these assumptions. We've seen inflation come down materially, although there seems to be stickiness in making it go down more slowly, and there's possibly going to be some bounces over the course of the next year. You might see some upticks as well as downticks, but inflation's down from those peaks. You will remember the discussion over the last 3 years about whether all of the monetarists, and as a child of Margaret Thatcher's Britain, we had monetarist wars in the UK and the press about economic policy. So I do have an emotional tie to monetarists, believing that inflation is always to do with money supply. But a lot of this inflation was to do with total disruption of supply chains as well. So inflation's coming down, but not all the way. And that means we're in a higher rate environment. But the idea of higher for longer seems to be the case. In fact, there was an article I saw a couple of days ago from Bridgewater saying we need to rethink the case for whether there should be any rate cuts this year. Now, probably there still will be. That's a low probability that would be zero. But the idea of a marketplace where you have inflation still a little bit warmer than you'd like, and you have the stock market going great guns, and you have the economy going great guns, well, maybe rates could come down, but how much do they need to come down to the very low levels we saw before? So it's possible the market is overexcited still about expectation of rate drops this year.
Do you think that the expectation of Fed rate cuts is still perhaps a little too optimistic? I mean,
Yes.
6 months ago, the majority of economists were predicting a rate cut this month.
Absolutely.
Now they're saying, well, maybe it'll be a couple of months, but it would seem right now that, and the Fed chairman said yesterday that there'd be rate cuts, but he's definitely indicating he's going to go slow.
Absolutely. The remarks yesterday were very much more hesitant than they have been over the last few months. Yes, I think we're in the higher for longer camp, and that the market is overclubbing the expectations of, as always, markets want their dessert now and they want it, the biggest possible portion. And they're overclubbing that expectation. There probably will be some rate cutting behavior sometime this year. but the market is likely to be disappointed. And one of the components about that rate cutting behavior is it's tough for the Fed to change policy and start cutting rates close to a presidential and, a big federal election as well. So that's kind of a short gate they've got to kind of wiggle their way through, and particularly if, the volume escalates about economic policy, which doesn't seem unlikely, that might make the channel they have to walk down a little more tough.
Again, unfortunately, they're political opinions and considerations, but when you have a potential president who favors a default and favors all sorts of easy money policies, I think that's a great cause for concern.
As you said, we are very careful not to, for a number of reasons, A, express political opinions in general, but B, the impact of politics on markets is usually less in the short term and more in the long term, if that makes sense, in the sense that it's very easy to predict, politician A is elected, therefore thing B is going to happen, therefore the implication for markets is going to be thing C. And in practice, those connections are weaker and more fuzzy than often you would think. So where I'll agree with you is that the question of monetary policy and economic policy is likely to be something that a lot of people are fighting about over the course of the next 6 months. And when you're looking at government refinancing, when you're looking at the path of interest rates, I care less about the direction of the fighting, if that makes sense, and more about the volume of the arm waving and the volume of the yelling, because the volume of the yelling increases the risk possibilities in markets, because either something could go wrong or markets decide. Markets are funny. They take the opportunity, they're having a good time and then they're feeling a little stretched, so they take the opportunity for something that would normally not trouble them to go, oh, hang on a second, now we're going to reassess risk. We saw that last year with the banking collapses that we had, where suddenly everyone cared about bank balance sheets where they hadn't cared about them before, and then 3 weeks later they stopped caring about them, even though plenty of bank balance sheets were still concerning. So that's more the implication of the presidential election in the short term, probably.
Question.
Yes, please.
The prior slide showed the yield curve and some different dots.
Yes.
What's your expectation? Short end coming down, long term going up, or?
So the Fed controls the short end, and our expectation is higher for longer on the short end. So the short end staying higher than people would ideally like. Everyone would like the short end to come down because that makes everything cheaper in terms of money. So probably that is relatively likely to be anchored for the next few months at higher levels.
The short side?
The shorter end.
Yeah.
The question is whether the long end is, this is my interpretive dance description of the yield curve, whether the long end will come up or whether the long end will stay where it is. And I think markets want the long end to stay where it is or go down. But in practice, there's a danger that because rates are higher, you might see some of, the 10 and the 30 get higher yields over the course of the next few months. So certainly on a very tactical basis, so we think tactically as well as sort of strategic terms. On a tactical basis, if someone was saying over the next couple of months, how do you think? We're kind of short rather than long duration enthusiasts if you're having that duration fight.
Is this inversion that's been, in my view, and I don't know the history, that's what I'm asking, that it seems like it's been very substantial, this inversion, and for a long time now. Is it that substantial and long compared to other inversions? Because it seems like we should be in a deep recession with that inversion.
Well, so it is somewhat unusual in length and depth. The question is, The underlying question is a yield curve inversion, how robust a signal of things going wrong in the economy is it? And the answer is, most of the time it has acted as a signal, but not universally. And at the moment, there's a bunch of funky stuff going on that's driving some of that behavior. That means this time, now, we were firmly mid to late last year in the recessionary camp, thinking that higher rates were going to drive fragility across the economy, and that was just wrong. The US economy has been remarkably stable. So yes, it's unusual and we don't like to see an inverted yield curve, but it's possible that we'll have one for a little bit longer. When it corrects, the likelihood is, we think that rates higher for longer, long end comes up a little bit, and then the Fed is able to get that short end down eventually. And so you get towards a more flattened yield curve.
Okay.
Yield curve because of that. But as anyone that's been in the fixed income market knows, predicting yield curves really is the Super Bowl of hard things, right? But with math as well, so that just makes it even worse.
Thank you.
So equity fundamentals, the US equity market has been producing great earnings, but is quite expensive. Credit spreads are, they ticked up a little bit. Defaults have ticked up a little bit, but in reality, credit spreads are relatively tight. The market is not doing a Danger Will Robinson, red flashing thing in the credit space. Higher for longer, as we said. The Fed is expecting slightly higher interest rates in the longer term than the market is. They're relatively close. Our view is that you're going to get probably, because of the strength of the economy, because of all of the things that are sort of going well, the pressure. It's kind of funny when you think about it dispassionately. Why do rates need to come down? Well, rates need to come down because we thought rates were high because we thought the economy was fragile, right? The economy's doing a darn good job of being not fragile. Markets are doing a darn good job of being not fragile. So let's go back to, why do interest rates need to go down significantly? Answer, well, let's keep kicking it down the path, but higher for longer. And fixed income relative to US equity earnings yield. Fixed income is competitive. Fixed income was out of the game as a competitive asset class for quite a long period of time. Now you get paid to own fixed income of all different types and flavors. And it's, as you can see in the past, you don't often see, certainly you haven't for quite some time, seen that relationship where fixed income yield and earnings yield for the S&P have been pretty much near as damn it the same thing. So that's quite a change.
Ian, before
yes, please.
we move on, you're talking about the fixed income and the economy and where we thought we were going to be versus how well we've held up. What effect, and from my reading, the biggest red light that keeps flashing at me, I'm not saying that I see it, but it's being flashed at me, is the debt rolling over for all the commercial office real estate. And, I've read Armageddon scenarios of this is going to wipe out a portion of our banking system, especially in urban areas where the community and the smaller banks. Have we baked any of that into this?
So we don't bake that into our capital market, our 10-year capital market assumptions,
Right.
because of that kind of dispassionate component we try and do there.
Right.
But this bit of the conversation, we do talk about that. And in fact, that piece that I brought out at the start of the year, this is one of the, in terms of risks on the horizon, this is one of the things where, again, none of these rise to the 50% probability, but this is one of the things to be concerned about. So you can see a scenario where medium-sized, regionally and locally important banking institutions who already have balance sheet problems because of the way that the balance sheets, the loan to maturity problem and so on and so forth, and who have got very significant exposure to real estate in their local marketplace. Those guys, if the continued bleeding in real estate goes on, in commercial real estate goes on, there remains the possibility that you get a problem spiral in one random, again, I don't know where, but it's not a global bank problem. It's a second or third tier down from that in unnamed, medium-sized metropolitan area, let's say. Something happens which causes one of the important banks in the community to have a problem, which causes others, which means that people start drawing their horns in, which means that the people around the board tables of all of those banks elsewhere around the country start going, well, hang on a second, this could happen to us, so we tighten the screws for local lending, and also the people that they owe money to begin to have that same concern. That's not a pretty picture were that to happen, and that's a possibility that could happen, because those banks are big enough to be locally and regionally important, and small enough to be too many to give, a big hug to universally, and exposed to that commercial real estate problem, which, as we've said, continues to be an issue because of fundamental working pattern changes. And as we all know, that is not just an issue in New York and San Francisco, that is an issue everywhere. It is now universally understood that working from home is something that, on average is, call it 3-4 days a week. That gives you a pretty material reduction in office space need in some form. And so, as you were saying earlier about the difference between core and value-added and opportunistic real estate, one of the interesting things about the real estate market is some core, which was supposedly the safest and most secure, some core is now looking really pretty funky, to use a technical investment term, because those buildings are 50% occupied, 40% occupied, and a building that's 40% occupied has a different value than a building that's 100% occupied, right? So, yes, that's a reasonable concern. It's not probable in the sense it's not 50% of the outcome, but it's the kind of thing that could happen and could cause a problem of a type we're not expecting.
All right, and not to belabor this, and I know we've gotten off path here a little bit. That is a risk. What do you guys see as a risk that's bigger than that? If you look around the other corner, is there a monster bigger than this one?
Well, that's a good question. So the first potential problem is equity market valuations are stretched if the economy tips over, and if the market just decides, you know what, I'm kind of done with this concentration thing, and I want to take some risk off the table, and so on and so forth, then you could see a downturn in equity risk, and downturns in equity risk happen regularly. Those aren't surprising. So that would be a normal risk, but a more probable risk because you get downturns in equity markets. That's the first thing. Second thing would be the general higher interest rate through the economy causing you to tip into recession just because. So the underlying question there is, how long does it take interest rate rises to flow through to the economy? The transmission mechanism of interest rates going up. How long does it take to slow the economy down? And so far, it looks like these interest rate rises have not slowed the economy down. It is possible that the reason for that is just the transmission mechanism this time is an awful lot slower than it normally is, but boy, that train is coming down the track. Now, we think probably by this stage that's relatively unlikely, but that's not impossible as well. So we could wake up at some point this year and realize, oh boy, those interest rates now are in fact beginning to bite, and that's going to process through the economy for 6, 9, 12, 18 months. We're just at the beginning of that effect. So that would be the second component, maybe.
All right, didn't mean to sidetrack you, and thank you very much.
I think I've maybe once in my career had a presentation that didn't end up being sidetracked, so I apologize. It's just, there's occupational risk with me. 10-year expected returns, again, this is more a ready reckoner for you guys to have afterwards than something to talk through. We've colored it by asset class and just showing that yes, asset classes tend to herd together. And you can see the stuff on the left that you expect to get to pay you more tends to be riskier than the stuff on the right. And fixed income is a bit higher than it usually has been for the last few years. Final chart, predicting markets. Fixed income, why do we focus on bond yields? Because bond yields are a really good way of predicting fixed income market. So this is core fixed income, the ag index. The beginning of a period, 10-year yield of that index is a really good predictor. You tend not to see R squareds of 0.9442 with very much in investing. So that's a pretty good predictor of what the fixed income market's going to give you, and many of the forecasts build off that fixed income market forecast. So it gives you some degree of reassurance that this is based off something somewhat robust rather than just the dartboard, which we don't actually have because I'm terrible at darts. So with that, I will stop yabbering on and happily answer any other questions or hear violent disagreement, which is much more fun.
Questions for Mr. Toner? None?
All right. Thank you all very much.
Mike, Mark, any additional comments?
No, I think that covers it.
All right, well, I can personally say that I enjoyed that, and thank you for putting up with my sidetracking questions. All right?
Thank you so much.
All right, I've just been informed that lunch is here, and I think it's appropriate that, yes, 12:04, let's break for lunch.
Yeah.
And, well, 15 minutes, and then we'll let Mr. Berg get into the delegated investment report.
Well,
while
we have a presentation from Mr. Wingo.
Oh, Mr. Wingo's
an
up
open
first?
session presentation, Mr. Wingo after that, so.
Okay,
Yep. Very good.
all right.
In 2020, the commission underwent a significant review of the strategic asset allocation in 2019 and 2020 and made some substantial changes to the strategic asset allocation. We moved in the direction of simplicity and really attempted to change the paradigm of the asset allocation to one that, kind of favored complexity and required simplicity to prove itself to one that favors simplicity and requires complexity to prove itself. But in doing that, and we ultimately reduced the policy portfolio from 18 different asset classes, 21 different benchmarks, down to 5. And the commission was very methodical and thoughtful about how it went about making such a significant change to strategic asset allocation. And also grounded that asset allocation in some new principles like the reference portfolio, which is that 70-30 portfolio that you see represented on the performance reports that you get, and thinking of that as a kind of a risk proxy for the policy portfolio. And then in deciding what that policy portfolio was going to look like and what asset classes are going to be represented and in what weights, benchmarks, ranges, all of those things were considered over a series of several meetings. And I think I would submit that the way that the commission went about this process was very thoughtful and in the approach of thinking about what type of portfolio do we need in order to meet our overall goal, which is earning a return that helps make the plan work. And so thinking about how the portfolio needs to be uniquely structured to address our needs as a pension fund versus, just attempting to kind of construct a portfolio of assets to achieve some rate of return at a particular level of risk. It was really driven by the components of the plan itself and trying to represent those components as we went through the process. And, Mr. Wingo gets a great or significant, probably the lion's share of the credit for guiding us through that process and developing the tools by which we went through that process. And what I've asked him to do is so we can ground ourselves into some foundation of when we start thinking about the strategic asset allocation exercise that we're going to do over the course of the next year, to ground ourselves in what we did back in 2020. So I've asked him to give us a review of an overall review or overview of what the commission went through in the thought process in setting the strategic asset allocation in 2020. Because, it's my hope that we, I don't think this is, even though this is a every 5-year exercise, we certainly want to be thoughtful in what we consider and that we consider other ideas. But I think it's also important that we ground ourselves in something. I don't necessarily think or believe that a zero-based budgeting process or posture is the best place to start. So I think this is a good place to start, a good jumping off point for us. And then when we have our education meeting in April, I'm going to ask Mr. Wingo to come back and talk about what's changed and how the components of our thinking have changed in 2020 have changed in the ensuing 5-year period since we were undergoing that discussion. So I don't think I did only 75% of your presentation. So there was an over under of how much I would do in the lead up.
I don't think you did enough.
Yeah.
I'd like you to keep going.
You always do. So especially when it's you. So, all right. Mr. Wingo, take it away.
I think that pretty much wraps it up.
All right. So any questions? Ask James.
Best presentation from James ever.
No, thanks, Mike. And as Mike alluded to, the issue that we wanted to address 5 years ago, Mike and Jeff challenged my team to really take what you guys face, which is, I think, a monumental challenge of taking the actuarial assumptions, the capital market assumptions, but integrating those into what does that mean for our asset allocation. And so what we were challenged with was to create an analytical framework to make that into, as thoughtful but straightforward a process as we could. And so when we looked at that, we wanted to consider, 5 years ago, when we set out our objectives for the strategic allocation process, we wanted to, one, set the appropriate total plan risk. Here we think of this reference portfolio, the stock bond mix that approximates our kind of risk barometer, and then look at the most appropriate direction of portfolio migration, and then also review several portfolio themes that were consistent with that. So before I jump into going through that framework specifically, I wanted to kind of orient ourselves around what we're trying to look at and what the nature of our challenges here. These are two charts that we look at that I think are really fundamental metrics that we look at with the system to project. If you look at the chart on the left, this is our funding ratio over a 30-year time period, a little bit of where we've been, but then importantly the projection about where we think we are integrating our actuarial and our capital market assumptions. And this is as of today, looking forward, and you can see where we expect to get from that. And the other side of that coin is over here, if I can direct your attention over towards the back one there. If I can direct your attention over towards the contribution rate assumption here. You can see where we're at today and where we expect to be in the future. One of the really important things that I would highlight here, and I think Ian mentioned this quite a bit as well, is that we don't really think about the future as a point estimate. It's very important for what we're doing here to think about the future as a range of probable outcomes in terms of probability. So if you look at this chart on the left, you can see the black line that represents what the baseline expectation would be, but you can also see a wide range of outcomes. In the green, you would see where roughly 50% of those outcomes are expected to fall for us. And that gives you a sense of the risk that we're taking. And the same thing with respect to contribution rates. So when we think about asset allocation, one of the things that's important to orient around is thinking about really the choices that we make as being an exercise in managing trade-offs. We could shorten that period. If you look at the baseline projection to achieving full funding ratio, we could shorten that period and take that projection inside the next 10 years, for example, if we wanted to. But the cost for that would be not only an expansion of the outer bands of that risk profile would widen out, but also we would look at the expansion of the bands with respect to contribution rates as well, and we would run a higher risk of triggering a contribution rate increase over here. But then, of course, conversely, if you take the other side of that, we could run a portfolio that had much lower bands, much less risk. We would, of course, extend that period and take much longer to achieve full funding status. And at the same time, the other side of that coin is we would need to talk with the legislature and explain very clearly, well, these contribution rates aren't going to be elevated for the next 10 years. They're going to be elevated for the next 20, 25 years, potentially. And we look at that. So let me move on from there and go into what we talked about 5 years ago with respect to our objectives. So the framework we created, we wanted to say, okay, if we were to boil it down 5 years ago into four things that we cared about a great deal as a plan, it would be, on the one hand, achieving and maximizing the probability of meeting or exceeding the plan's assumed rate, which is currently 7%, was then I think 7.25%. And then also maximizing the probability of achieving a full funding level within a given period of time. In this case, 30 years, what we're looking at. Then on the other side of that coin, we wanted to minimize the probability of triggering contribution rate increases beyond what was provided for in the 2017 legislation. Also, plan tail risk, we want to, of course, minimize the probability of catastrophic plan outcomes. So let's jump into what that looked like 5 years ago when we looked at this. If you look at a framework and how you translate these goals into risk-return space, if you look at the goals of maximizing probabilities of beating the assumed rate, you would characterize that risk or that objective as that red line you see there. That does have a slight upward slope because of the cost of volatility as you go out the risk curve. So if we were to maximize that, we'd be moving essentially as far away and above that line as we could. And so you can see here, above that line is the area that we'd want to live in. So those are relatively straightforward objectives to me. The interesting thing, I think, comes in when you bring in the other objectives. And this relates to the objectives of minimizing the probability of triggering contribution rate increases, as well as left tail sort of catastrophic plan outcomes. If you integrate those risks into the plan, what you get is an additional line that further focuses your actionable portfolios that you can select that actually takes a different slope. And that's interesting because what you're really theoretically trying to do is maximize your distance away from those red lines, if you can do it as you think about risk return space. So portfolios, as we define them 5 years ago, that are on the right and lower side of that red line are portfolios that have a higher than 5% probability of triggering a contribution rate hike inside the next 10 years. That's how we sort of quantified that objective. And so portfolios over here to the left and higher than that meet that objective. So we have to overlay reality on this as well, and this is where capital market assumptions come in. If you look at the efficient frontier, this is telling you what is, if you push as far as you can in terms of risk efficiency, where are the limits to that? And so that further focuses our choices with respect to asset allocation. So also one of the things we want to look at the time, if you go back to 2020, was where are our peers allocated? If we take capital market assumptions and we map out all of our different peers that make up our peer group, we can see where those fall out or where those shake out in terms of what we wanted to do. And not that this is the thing that guides us. Every individual plan has their own set of objectives and parameters that they're targeting, but we certainly didn't want to be in a position of 10 years forward scratching our heads wondering why we were in the bottom quartile of the peer group when if we could look at this, we might understand, okay, well, that is consistent with what our expectations actually should have been based on capital market assumptions at the time. So if we said we wanted to at least not,
I think this is, important for us to think about too, because of the way that these portfolios are allocated, and as James said, it represented kind of what we could figure out what the peer allocations were at the time. Just because one of these peer allocations doesn't work for us, like for instance, the portfolio that's way out there to the right, because that doesn't necessarily fit within our risk tolerance, doesn't mean that it doesn't fit within that plan's risk tolerance, because of the particular aspects of their plan, whether it's funded status, contribution rates, whatever, that their risk line could be still to the right of that. So they could afford to take that much risk, right? And the same thing goes for, you've got the plans that are below the red dotted line, right? They're not taking enough risk in order to make our plan work, right? So this was very eye-opening to me when we were going through the exercise of seeing the difference and how, even though we're the same, we're different, right? We're all trying to do the same thing, but we're all trying to do the same thing for our particular plan.
Yeah, I think it's interesting. I mean, if you were to look at our asset allocation as of 10 years ago, for example, we were actually somewhere in this area. So the truth is we were getting results that were in line with our expectations of what they would have been had we been looking at this data. It's a little bit nuanced to kind of develop all these assumptions for a range of plans, but it was an exercise we really hadn't done at that time. So it's interesting. So basically, if we want to not underperform or at least have an expectation to perform in the top half of that peer group, we can draw a line through that and generate an acceptable or actionable range of portfolio choices that are further sort of constrained inside this smaller triangle up here. So if we move forward as well and we look at the decisions that we made and where we were in 2020, we ultimately made a decision that I think was in line with not only what we wanted to achieve with respect to our likelihood of achieving a full funding level and outperforming the assumed rate, but also in context of our planned liabilities and what we wanted to avoid in terms of risk. And you can see the direction that we kind of moved. We were here in this portfolio, we kind of moved in this direction. And so, theoretically, if you look at this line and you want to simply, and you're worried about achieving a full funding level over a given time, you'd simply move up in this direction. Whereas if you simply are worried about not triggering a contribution rate hike, you would move more in this direction over here. And if you're worried about everything, all of the risks that we look at equally, you would pick a point somewhere in here and move sort of this direction. And you can see that that's roughly sort of what we did with respect to capital market assumptions at the time. We overlaid also, where we thought a good reference portfolio would be with respect to the stock bond mix. You can see 70-30 stock bond mix roughly approximates the level of risk that we were taking at the time. And so that's, how we developed our reference portfolio assumption. But overall, as Mike alluded to, there's not really, given our liability structure, given our in-place portfolio, there's not really a zero-based budgeting concept that makes sense. Everything is a decision from where you're starting at today in terms of your incremental moves, what you can accomplish with the portfolio. And, we're kind of illustrating here in risk-return space what the advantages and disadvantages are of different moves in risk-return space. If you kind of obviously want to be risk efficient, you can actually move more in this northwest direction where you're actually taking more return and less risk, or obviously this is the sort of the least efficient direction you can think about. What gets a little bit more nuanced is sort of what I've shaded in yellow here is directions that are typically more associated with just a simple stock bond rotation where you're taking, more return but more risk as well. And so what we wanted to kind of illustrate is use capital market assumptions to say what are the implications with these moves at that time. And if you go back 5 years ago, where were capital market assumptions were at the time, and what were the basic rotations that were implied? And these are going to be very different than today. But at the time, this was a different environment and a different sort of level of rotation that was implied with respect to that. So really, I think that's what I have prepared for today. I think our goals 5 years ago were to develop as thoughtful but simple and straightforward a process we could to kind of translate what the implications were from the actuarial assumptions, the capital market assumptions, and what that meant for our asset allocation choices. So, hopefully we'll use an equally thoughtful approach as we go forward with the 2025 exercise for asset allocation.
Can you go back to the triangle? Which this sold me 4 years ago. So I've always kept it in my mind. So if we did this again, new now, that first line would move down because we're at a 7% return, is that right?
Yeah.
Okay, and so this, and maybe we do this in the COP, but do we update or this every year and make sure we're still, based on what we're doing that year, we're still in the right quadrant?
I think you see that.
Right triangle?
Yeah, Bill, I think you see that more probably in the tables 1 and 2 than necessarily you see in this. We kind of see this more as a guidance for the setting the this is something that we would revisit every so often rather than necessarily trying to do this every year, because you shouldn't see that much difference in the implied moves year over year, right? So, but you're going to, one of the things that we'll do is when we come back in April, you'll see this, what this is now, basically, if that makes sense. Yeah.
But you're just saying it doesn't make
I don't
a
think
whole
it
lot of
makes,
sense in the interim?
not as much as I think because you see it, I don't think it makes as much sense in the interim as it does more when you can see kind of more the impact of time, because the slope of that efficient frontier will change. That will, correct me if I'm wrong, James, but that'll probably flatten out more. So there's less efficiency there'll be less efficiency potentially in taking additional risk than there would be. But if you did that year over year, you wouldn't see as much of a change.
Yeah.
If that makes sense. So it's not that we can't do it, it's just that I think it has letting time go by a little bit gives you a greater sense of what's different, if that makes sense.
Okay.
Yeah, you do see the information here, 90% of it in the projection charts that are in the SIOP every year, and those are things that we do update and track every year. But at the same time, those don't really change that much. I mean, in terms of what's going to change them, it's as we get new actuarial projections, new actuarial evaluations, and new capital market assumptions. So if you think about it on an annual basis, and those are things in there, you can look at those and see the probabilities as well in terms of what's changing.
Thanks.
But
Any other questions for Mr. Wingo? Thank you, James. Next up, if I'm not mistaken, it's the Delegated Investment Report to be given by Mr. Berg.
We have, as always is the case, we have sent you materials relating to all of these, but these are the investments that we have closed since the prior meeting. And pursuant to policy, we share these. And of course, we are able to answer any questions, but usually don't spend a whole lot of time on this one, so.
All right. Okay, next up on the agenda is for us to recede into executive session. We don't need a motion to do that. I'm going to ask our CEO to read that motion for us, please.
Mr. Chair, the proposed motion is to proceed into executive session to discuss investment matters in certain portions of the consolidated annual investment plan, statement of investment objectives and policies pursuant to SC Code annotated sections 916-80 and 9-16-320, including a comprehensive review of the bonds portfolio performance and a discussion of various underlying holdings, and a review of potential investments in the due diligence process, to discuss personnel matters and to receive advice from legal counsel pursuant to SC Code annotated section 30-4070, A1 through 2.
May I have a motion? I have a motion. May I have a second?
Second.
I have a second. Any discussion? Call the vote. All in favor of proceeding into executive session, please say aye.
Aye.
Any opposed? We're now in executive session. Could the staff